Welcome to the continuation video of the Bitcoin momentum strategy. If you haven't seen the first episode, I recommend you go back to it. You'll find the basic principles and logic we'll build on today. Today, we're going to dive deeper. I'm going to show you specific best practices that have worked for me after carefully studying research studies, white papers, and the experiences of other traders. We'll talk about choosing appropriate periods for moving averages, scaling positions by volatility, indicator combinations, realistic backtesting, and how momentum fails and what to do about it. Finally, I'll give you a glimpse into my own workflow, how I prepare my data, write entry rules, and evaluate system performance. So if you're serious about trading Bitcoin and looking for a way to manage risk, improve returns, and survive even the wildest market swings, this video is for you. Let's do it. Let me share a few concrete best practices that emerged from my deep dive into research papers, white papers, and blog posts. First, choose look-back periods that suit your timeframe and risk tolerance. On a daily chart, I lean toward a 10/50ths or 14/50ths EMA combo because it strikes a balance. Fast enough to capture most strong moves, yet not so tight that it triggers on every minor wobble. If you're day trading or scalping on 1 hour or 4 hour bars, you might go for something like a 12/26ths MACD or a 20/50ths EMA. In my experience, those shorter intraday lookbacks can capture quick bursts of momentum that happen when markets open in New York or when big news hits at 4 p.m. Coordinated Universal Time. Second, always scale positions by volatility. As I mentioned, if I want to target a 10% annualized volatility, I calculate the 14-day ATR divided by price to get a 14-day volatility estimate, convert that to a daily basis, and then size my trade accordingly. That way, when Bitcoin's daily ATR is $3,000, or roughly 6% daily volume, I'm much smaller than when ATR is $1,000, 2% daily volume. Without volatility scaling, you risk overexposure just when the market is most wild. Third, combine filters. Rather than relying solely on a moving average crossover, I also check that RSI is above 50, or MACD is above its signal, or ROC is positive. Often I require 2 out of 3 secondary indicators to confirm an entry. That lightweight consensus approach reduces whipsaws. Likewise, I use volume filters. You might only take a long trade if volume is in the top 75th percentile of the last 50 bars. In commodity futures, you might not need that because volume is deep and reliable. But in crypto, where volume can drop off weekends or holidays, this filter helps avoid buying what turns out to be a meaningless price tag. Fourth, embrace risk controls. I set my ATR-based trailing stop at 2 times ATR, 14, on daily bars. I also have a fixed 15% max drawdown rule. If my account equity ever drops 15% from its recent high, I liquidate and pause for a week. I usually allow myself to re-enter only if, after the 7-day pause, volatility has fallen and my equity is back within 10% of its previous peak. These simple rules have saved me from blowups in the most violent drawdowns, like March 2020 or May 2021. Fifth, realistic backtesting. I assume a 0.5% round-trip cost, fees plus slippage, on daily trades, and up to 1% if I'm trading hourly and need to cross the spread quickly. That ensures I'm not fooled by a strategy that looks amazing on paper but fails when you place real orders. For cross-sectional momentum, ranking multiple coins, I also watch for survivorship bias. Many coins that were hot in 2017 got delisted by 2019. If you exclude those dead coins, you'll overstate the profitability of a buy top 10 coins by momentum strategy. Sixth, continuously monitor and adapt. I look at my performance metrics, Sharpe ratio, win-loss ratio, maximum drawdown, on a rolling quarterly basis. If suddenly my Sharpe ratio drops from 1.2 to 0.5 over 3 months, I dig in. Am I just experiencing a drawdown, or did the underlying market regime change? For example, during the 2024 bull run when Bitcoin soared above $90,000, many momentum runs were so explosive that the classic 5100s cross was too slow. In that scenario, a lot of traders cheated, by going to a 20/50ths or even a 10/30ths lookback mid-course. That's fine, but you need to know that when you tweak your lookbacks so drastically, you may be trading on noise instead of trend. The mark of a robust system is stability. If you can use a relatively narrow band of lookbacks and still capture, say, 80% of the upside over multiple cycles, you have something repeatable. Let me share a practical walkthrough of my typical workflow for building a momentum system. First, I gather my data. I pull daily OHLCV from Coinbase Pro's API, and I also download the same history from Coin API. I line them up on UTC midnight candles and check for missing data or outliers. If an exchange's price is off by more than 2% from the aggregated feed on any given candle, I investigate. Sometimes it's just a bad candle that needs to be removed. Other times it's a real flash event that I need to keep. Next, I write a Python script that computes indicators. EMA 10, EMA 50, RSI 14, ATR 14, ROC 14. I store those in a pandas data frame so I can scan for entry and exit signals. Then, I define my entry rule. If EMA 10 greater than EMA 50 in RSI 14 greater than 50 in ROC 14 greater than 0, and today's volume is above the 75th percentile of the last 50 bars, I generate a buy signal. If I'm not already long, I calculate position size by target volatility. Convert 10% annual volume to daily. Divide by square root 252. Divide that by ATR 14, price, and cap at 50% of capital. If I already have a position, I do nothing. For exits, I have 3 triggers. If EMA 10 less than EMA 50, if RSI 14 less than 50, or if price touches my trailing stop of entry _ price 2 times ATR 14 at entry. Whichever happens first, I close the position at the next market open, or intraday if I'm watching, depending on how urgent the stop is. I code this up using CCXT to interface with Binance, since that exchange has good liquidity and a straightforward API. When my script sees a buy signal at UTC midnight, it attempts to place a limit order at the previous close plus a tiny tick, like 0.1% above, so it's likely to fill quickly but without dribbling too much slippage. If it doesn't fill within, say, 1 hour, I cancel and re-evaluate. If the signal still holds, I place another limit at the current close plus 0.1%. If volatility is high, I might switch to a marketable limit, a few ticks away from the best bid, to guarantee execution. Each fill is recorded with the actual price, quantity, fee, and timestamp. I update my trailing stop once per day, using the closing ATR, and I also check intraday to see if price has crossed that stop. If so, I immediately market sell. At the end of each month, I run performance analytics in Python. I calculate daily returns, cumulative returns, Sharpe ratio, Sortino ratio, max drawdown, win-loss ratio, average trade duration. I compare these metrics to a pure buy and hold and also to a simple 5200s SMA crossover, just to benchmark. If my strategy's Sharpe is significantly higher, say, 1.3 versus 0.6, and max drawdown is lower, say, minus 18% versus minus 45%, I consider that a success. If not, I dive back into the parameter optimization stage. I might try a short EMA lookback between 5 and 20, a long EMA between 30 and 200, an RSI threshold between 40 and 60, and see which combination yields robust performance over the last 3 years. But I'm careful not to choose wildly different parameters each time. If today's optimization says 7/45ths for EMAs, but last quarter it was 12/50ths, I ask myself, is the market really shifting, or is this overfitting? Usually I prefer something near the center, like 10/50ths or 14/60ths, unless I see a clear structural change in market behavior. Let's talk about some common mistakes I've seen, and sometimes made myself, so you can avoid them. One classic error is overfitting to a single bull run. If you only look at the 2017-2018 cycle, you might think a 5/20ths EMA crossover is magic, because it would have captured almost all of the 2017 run. But when 2018's bear market hit, that same system would have whipsawed in choppy sideways price action, giving you a string of small losses. After a bear, momentum systems often underperform until the next strong trend emerges. To avoid this, always test over at least 2 complete cycles: a bull, a bear, and a recovery. If your parameters work only in one of those phases, they're likely not robust. Another pitfall is ignoring tail risk. Suppose your backtest looks great because you only took exits at the end of the day. But on March 12, 2020, Bitcoin dropped 40% intraday before your daily exit signaled you out. That's why I insist on ATR-based trailing stops and crash detectors. When I see a 5-minute candle down 10% with volume in the top 1% of the last month, I flatten out immediately, even if my daily EMA crossover is still bullish. It's a bit of a belt and suspenders approach, but in a market that can flash crash, I'd rather avoid catastrophic losses. A third mistake is ignoring liquidity and execution costs. In my early days, I assumed zero slippage when I was testing my strategy. Then I went live with $50,000 and discovered that 0.5 BTC orders were pushing the bid-ask spread a few $100s. That eroded profits on small moves. Now, I always bake in at least 0.25% slippage on each side for mid-sized retail trades, and if I ever scale beyond a few $100,000, I measure real slippage over a 3-month window and use that empirical figure. If my average slippage is 0.4%, I assume 0.5% in my models so I have a buffer. Next, I want to illustrate how momentum can fail, and how to prepare for it. In a sideways or range-bound market, momentum systems often whipsaw, generating a series of small losses that add up. If Bitcoin spends 3 months bouncing between $45,000 and $60,000, a 10/50ths EMA crossover will flash buy whenever it ticks up near $48,000 and sell when it falls near $47,000, over and over. To guard against that, I monitor volatility. If 20-day ATR drops below, say, 1% of price, I either widen lookbacks, for example, switch to a 2100s EMA, or switch to a mean reversion overlay, such as buying at the lower Bollinger Band and selling at the upper band. That way, if the market is truly range-bound, I'm not fighting it with a trend-following system. Another case where momentum can break down is during sudden regime changes. For instance, regulatory news like rumors of a major government crackdown can snipe your stop-loss before your trend filters have a chance to flip you from long to short. That's why I sometimes employ a sentiment check. If on-chain data shows massive withdrawals from exchanges, indicating whales exiting, or if social media sentiment spikes negative, scored by a simple keyword tracker, I might halt new long entries until things calm down. It's not a perfect system. Social sentiment can be noisy, but it adds an extra layer of protection when a black swan event looms. Whales and market manipulation are another reality. Imagine a large player dumps $200 million of Bitcoin on a low-volume weekend. They prey on momentum traders by causing a false price plunge that triggers stops. By the time the smoke clears, they buy back lower. To defend against this, I avoid trading when volume is extremely low, like on Sunday night's UTC, and I cross-check price feeds across 2 or 3 major exchanges. If only one exchange shows a sudden 5% drop while others remain steady, I know it's likely a spoof or localized dump, so I don't trust my signals from that candle. Overcrowded momentum is yet another challenge. In 2021, when Bitcoin surged towards $65,000, nearly everyone was running a 10/50ths EMA strategy. That herd behavior pushed the price even higher initially, but eventually, when every momentum trader flipped to a bearish cross, the dump was brutal because there was no bid left. That's sometimes called a momentum crash, where the unwinds are self-reinforcing. My strategy to mitigate this is twofold. First, I introduce small random variations in lookbacks, as mentioned earlier, so I'm not triggering at exactly the same moment as everyone else. Second, I layer in volume analysis. If volume suddenly spikes while price is crossing my moving average, I might ignore that cross if volume is, say, in the top 99th percentile. The idea is to avoid joining the crowd at the precise moment of peak excitement or panic. Now, let me share some of the real-world benefits I've experienced with a well-constructed Bitcoin momentum strategy. Over the last 2 bull-bear cycles, a properly risk-controlled momentum system has captured roughly 70%–80% of the upside in Bitcoin during its bull runs, while suffering drawdowns that were 50% to 60% smaller than buy and hold in bear markets. For example, from January 2020 to December 2021, a simple 10/50ths EMA crossover would have netted about 900% gross return versus Bitcoin's 1,300%. That might look like lagging, but remember that drawdowns were smaller. During the March 2020 crash, the strategy sold near $5,000, staying out through most of the 2020 drawdown, then re-entered around $6,500. Whereas buy and hold stayed in and suffered deeper losses. In 2022's bear market, that momentum system didn't go short. I don't short on daily bars using this particular setup, but it did stay in cash, avoiding a lot of the downside. Over the full 2-year span, the momentum approach had a sharper risk-adjusted return, Sharp of roughly 1.1 versus buy and holds 0.6. For those who want to take momentum further, you can consider cross-sectional approaches. I once ran a test on the top 15 cryptocurrencies by market cap, and ranked them by 1-month return, then allocated equal capital to the top 5 each week. That cross-sectional momentum portfolio outperformed Bitcoin alone by a few percentage points per year, but suffered much higher drawdowns in late 2018 when many altcoins collapsed. So it's a trade-off. Cross-sectional adds diversification, but it also adds complexity and the need to manage coins that can be incredibly illiquid. My advice: if you have the bandwidth and can handle the operational complexity, multiple wallets, multiple exchange pairs, go for it. Otherwise, mastering a time series momentum system on Bitcoin alone is a fantastic first step. As I look to the future, I'm excited about combining momentum with other approaches. One idea I'm exploring is adding a mean reversion overlay during times when momentum stalls. For instance, if Bitcoin's price closes inside its 20-day Bollinger Bands and RSI hits extreme levels, say RSI greater than 85 or RSI less than 15, I might switch to a short-term mean reversion mode, buying dips or selling rallies for a quick scalp, rather than waiting for a moving average cross. Another avenue is incorporating on-chain sentiment data, like net flows into exchanges or the ratio of active addresses. If momentum is strong but on-chain data shows large exchanges suddenly receiving millions of dollars of inflows, that could indicate selling pressure building, and I might hedge or tighten stops. Before wrapping up, I want to emphasize who can benefit most from a Bitcoin momentum strategy. If you're a retail trader just starting out with $5,000 or $10,000, you can implement a simple EMA crossover on TradingView and set up alerts. Even if you don't automate orders, getting alerts and then manually executing limit orders can still work well. If you're a semi-pro or algo trader with $50,000, $500,000, you can run a Python script using CCXT, aggregate your own data, and build in volatility sizing and multi-indicator filters. If you're an institutional allocator, you can use a momentum allocation as part of your overall crypto exposure. Maybe 10% of your crypto book goes into systematic momentum, while 90% remains in a more discretionary long-only bucket. At that scale, you'll need advanced execution algorithms, risk oversight with value at risk, VAR, limits, and stress testing against extreme historical scenarios, like a 40% one-day drop. It's also important to recognize the scenarios in which momentum fails. In prolonged range-bound markets, your momentum system can bleed money. That's when I switch to a mean reversion or a smaller position size, or simply sit in cash and wait for a clearer trend. During rapid regime shifts, like a sudden regulatory crackdown or a massive hack, your momentum signals may not trigger fast enough, so I keep my crash detector enabled to exit instantly if big red flags arise. And in crowded momentum markets, when everyone is keyed into the same signals, I introduce randomness and volume filters to reduce the chance that I get swept out in a mass exodus. Finally, I want to leave you with a practical blueprint. picture this as a narrative you might use in your own life. You wake up one morning and see Bitcoin jump 10% overnight. Instead of Googling, "Is this a pump or the start of something bigger?" you let your algorithm do the work. It checks. Is today's close above yesterday's 10-day EMA and above the 50-day EMA? Yes. Is RSI above 55? Yes. Is ROC positive? Yes. Is volume in the top quartile of the past 50 days? Yes. It tells you, buy now. You place a limit order at the current close price plus a tiny tick, and you get filled. You calculate your position size so that if volatility stays at current levels, your annualized risk is 10%. You set a trailing stop 2 ATR away. Over the next days, Bitcoin climbs another 15%. Your trailing stop drifts up behind it, never triggering, so you ride the wave. Then one afternoon, halfway through the US trading day, a large whale dumps a chunk of Bitcoin. Your crash detector notices a 7% drop in the last 10 minutes accompanied by a volume spike in the 99th percentile. It says, flatten now. Your stop might still be 12% below your entry, but because the crash detector is faster, you exit at a small loss instead of letting a 20% drop wipe you out. You reassess, wait for the dust to settle, and when the 10/50ths EMA crossover reasserts itself, you'll re-enter. That's how I ride the crypto wave with momentum. Methodically, rigorously, and always mindful of real-world frictions and risks. I hope this narrative gives you a clear sense of how a Bitcoin momentum strategy really works, from the core indicators and backtesting best practices to risk management, implementation details, and real-world examples. By focusing on the why and the how, you'll be better equipped to construct your own systematic approach, adapt as markets evolve, and avoid the common pitfalls that can derail so many momentum traders. Whether you're a retail trader just getting started or an institutional allocator seeking diversification, momentum in Bitcoin can be a powerful tool, if, and only if, you treat it with the discipline and respect it demands. Thank you for listening, and if you like my insights, please like and subscribe.